Welcome, everyone. Today, we have the pleasure and honor to have Nancy Villacorta from Chicago Funding and Rahul Vishal from National RE Invest. Thank you for joining us today. They're going to be talking about finance and funding in the time of COVID-19. So thank you again for joining us. Rahul, Nancy, the floor is yours.
Thanks, Hugo. I guess let me know when you can see my screen.
We can see your screen.
Okay.
Yep.
Hey guys, those who don't know me, I guess Hugo invited us. I'm in real estate investment for maybe more than now 10 years. A lot of people know my partner Andrew Holmes. So we have a National RE Invest. That's the Real Estate Investors Association, which we run in Chicago, and now it's in lot of other markets. So we are in market in Florida, we're in market in Houston, lot of other places we have presence. So we are growing as our business is growing. So for the people who don't know me, I started investing back in 2010, and as all of you know, market was challenging, but there were a lot of opportunity, but it was a lot of risky. It was Andrew who kind of brought me to the market. He kind of explained the stuff. So that's where my journey of investing started. Since then, I started doing rental and then some flips. When I was working at Caterpillar, then I completely changed my profile. After 3 or 4 years of investing, I quit Caterpillar and I started doing investing full 24/7. Since then, now me and Andrew, we are partnered in most of the stuff we do, and we have 200 plus rental property portfolio in Chicagoland, and we are trying to expand into different markets as we get out of this COVID. So before I get into the financing and all that, I guess my co-host and lovely Mr. Nancy, if you want to just introduce yourself and we can go from there.
Thank you, Rahul. First of all, thank you, Hugo, for the invitation. We're really glad to be here. There's a lot of questions that a lot of people will have in regards to financing their first flip, or how do they get the financing in place by building a real estate portfolio. So my name is Nancy Villacorta. I represent Chicago Funding. And a little bit about my background. I've always been a mortgage broker for the last 25 years. I did residential lending, did a little bit nonprofit housing, advocating, loss and mitigation for 2006, 2008 when the crash happened. And I always had an itch, and I always wanted to learn, how do I connect with the right people to start investing? I tried to do investing on my end, on my own, with the resources or the knowledge that I had at the time, and it went badly, guys, like seriously. Residential lending is completely a different market than real estate investment lending. And in my journey and in my path of the residential lending, nonprofit housing, and as a mortgage broker all this time, just recently I came into meeting this wonderful group of people, and I met Rahul and Andrew and everybody here, and I slowly came back into this lending side on the other side, not the residential lending, but the real estate investment lending, and that not only helped me build and scale my own properties, because I'm also an investor, but we were able to help navigate the variety of products that are available, not just for the new investor, but for people that that are already seasoned. But how do we take their lending, and how do we take the financing to continue to build and scale their properties or their growth? So we're excited to be here, and we're going to talk a little bit about the difference and the different options of financing today, the different products, and just the different resources out there. And, I know there's a lot of information, but we'll try to navigate that together.
Yeah, and Nancy, like I said, the financing is really vast topic. But what we can do is, as the COVID is coming, I guess normalizing the whole system right now, at least in Chicago, in most of the other states, for this crowd in Chicago, a lot of the people are coming back to the normal life. I guess a lot of things are opening. We still have some issues going on in real estate market, but the financing, if you particularly look into that side of it, the things are opening up like really good. Like a lot of programs are coming out. People, and that's obvious because what has happened is in last year and a half, things were kind of on a low side. Most of the stuff happening on the residential market, and there was a less demand. There was not much volume in the market. It was sellers market. It's still sellers market, I would say. It's not changed that part of it, but slowly and sure, with all these, with the forbearance is stopping, it stopped. Like we had a good meeting yesterday with Ryan Smith, who's a leading short sale agent in our area, and his comments were like things were going to start opening up really fast because on the June end of the June, a lot of the forbearance programs were um, expired. So people who are behind on their loans and they're trying to get back to the normal, they might fall behind. It goes to foreclosure, and the things are going to start opening up. But going back to the financing, I guess I'm just these are the three. These are the things which I believe in. When you're in real estate is nothing but investing and managing money. If you can manage your money, if you can find the right solution at the right time for your investing, it's an investing strategy. How you juggle your money. If you have money, if you don't have money, doesn't make a difference. It's all about understanding who you are, what is your resource, and what kind of programs you have. And we'll go through some of the programs from my side of it, and then obviously Chicago Funding has a lot of different programs, which Nancy will go through that. And the third thing is understanding your profile. So, like I was telling before, I came into industry as I would say on accident. What happened for me is I was looking for a solution to invest some of the money which I accumulated over the years, and I was just not finding the right vehicle to get the investing. I tried everything else. I tried stocks. I tried investing in different businesses, but I was not really happy, or I was not really getting control over my investments. The results which were getting were not just enough for me, and that's how I came to real estate. When I came to real estate, I had like $150,000 to start with, and that time my knowledge was very limited, but my financial profile was good, and that's the only thing I got when I started investing, and I was able to leverage that profile to get into different type of properties, recycle my money to get to a new huge portfolio. When it comes down to real estate, there are really three things, and I guess Hugo covers those things in different seminars. But I guess you can wholesale a property, you can flip property, or you can rent property. Means that's about it, guys. Like there are three things you can do. There are a lot of different ways and a lot of different strategies you can use to do these three things. But you have to understand who you are. Like depends on the stage of your life. You have to understand. Okay, am I a wholesaler, or I'm a flipper, or I'm doing renting. For me, when it comes down to investment, when I started, I had a job. So I look at flip as a job. If somebody has a job, it really doesn't make a difference whether you're doing another. It's a lot of static here.
Hey guys, if you have your mics open, can we just ask everyone to mute their mic, please?
Thank you, guys. If you are, because there's a lot of disturbance coming. So basically, what I was trying to say is like when I uh, started doing investing, my profile was what we call as a busy professional profile. When you say busy professional, is you have a job and you're busy doing that, and that kind of pays your bills. That is paying all your expenses. and you're trying to get something on a side, which is generally people call it as a passive investment. So my profile, when I looked at it, okay, I don't want to spend time on doing wholesaling. I don't want to spend extra $30,000 to $50,000 per flip. Yeah, it's going to help me. Obviously, yes, I can get more money out of it. But again, once the project is done, then you have to go back and do the second project. So there's really not much for me as an investor on the flip side. And so third was the rental profile, and that's what excited me is if I can keep doing rentals on the side while I'm working, I can have a retirement income on the side, which will grow into a substantial amount when I can actually have an option of leaving my job. So that's the profile I chose, and for that, I started doing all my investing. So these are the three things you have to understand when you start doing anything in real estate: how to manage your money, what are the different programs, and then what's your profile. Because everybody has a different profile, and everybody can only use that resource. And I'll go through that quickly before we get into the um, get into the more details of these programs and what's the impact of COVID on these programs. But when you look at this slide, oops, on a flip side, on a rental side, you can. I'm playing with my screen here. Hold on. Okay. Uh, Step one and step two. Basically, for flip, there is no step two. You're trying to get the hard money or getting the money to buy the property or rehab the property, and then you're at the closing, you're paying it off. On the rental side, you're doing the same thing as your flip property, and then you're refinancing for a long term if you're keeping it as a rental. So the step one is kind of common to both of those, and as an investor, you need to find the least uh, capital intensive program for you. So when I say that, the cost your money to borrow, what is the cost? And that cost, if you minimize that, you're going to get more money at the bottom line. So your personal funds, obviously you can use that, but then that will be, once you use the personal funds, you're stuck for if a flip project for anywhere from 4 to 7 months, your money is stuck, and then you might lose another opportunity. But that's one source. Your IRA, you can fund through your IRA on if it's Roth or anything, you can fund through that. Home equity loans, that's where I actually started. When I started investing, before coming to real estate, I just didn't know where to put my money. So I was just trying to put money in my house, and then it had a lot of equity. So I took a home equity loan from my house, which kind of served as a funding source for me to start my first few projects. Then you have private fund, and then you have money. The way I wrote this thing is this: it's every program has a cost, and as you go from your personal funds to IRAs to home equity to private fund, your interest you're paying, the amount of interest per month you're paying to borrow that money, kind of goes higher from 0% to maybe 12, 13%. And that's what managing, when I talk about managing the money, that's where you need to manage your money, because the lower the cost of carrying, the higher the return on the back end. So when you start looking into your resources or your financial profile, you can leverage it based on what resources you have. And maybe you start with few, then you get into the next level, and then you go and use the better strategies. And that's how basically you mature into this process. On the rental side, on the back end, you can refinance. You'll have to refinance for long term, a 30-year fixed residential. So somebody who a profile like my profile, which is when I started, I had good credit, I had W-2 job, less expenses. So I was qualified for the 30-year fixed residential loan. And currently, the residential loan is at like 3%. It's ridiculously low. So anybody who has that profile, they should be utilizing that loan for your rental or your any other investment properties. You can do up to 10 total properties. One is your residential house, like your own residence, and then 9 investment properties. So if somebody who has that profile, they should be definitely using that option. Then you can go to 30-year fixed commercial. There are a lot of programs, and that's the Chicago funding comes into picture. Is they have a lot of lenders right now, and as we come out of COVID, everybody, all these hedge funds and everyone are coming up with a lot of good programs, and the interest rates are like 4% right now on 30 years. So they are maybe a point higher than a 30-year fix, but they are there. And then you have your small banks, which are sometimes more flexible to work with. They can look at the lower loans, like lower loan amounts, which is like less than 100,000. Some of the commercial loan programs don't look at that. So this is just in general. This is very basic, but once you understand basic, now you can pick and choose and use your strategies. So I kind of touched base on these already. But this is just to give you what is required, what are the requirements of these loans. So obviously, personal funds, credit and rate, income requirements, there's nothing. You have your money, you're the boss. And right now, cash is the king. So if you have something, if the properties are good, property makes sense. If you have cash, that's going to win the contract. So having a personal cash, because it's a seller's market, as we get from the sellers to buyers, things can change. But right now, people want to have the cash transactions close in few days because they have so many people to choose from. I mean, the sellers have so many people to choose from. So it's better to have that. IRA and 401k, you can always get loans from those. You can use that loan for your rehab. But it is within the restrictions of the programs, and depends on your program. There might be different criteria on those, but in general, up to 50K of loan you can get from your IRA, which can be money you can use for rehabbing if you're doing a flip or something. So that's one source. Home equity, like I said, they are way low right now, 2-3%, something like that. You can borrow up to like 80% of your, and this is based on your current house or any other investment properties you have. If you borrowed less, or if you have more equity left in that, you can borrow that equity, and that will be the cheapest source of income or cheapest cost for your money from that. Private fund, there are a lot of groups, and there are like private funding is available down there. In most of these small groups, it's a relation based. You need to know the person, you need to have working with them, you need to have some sort of a relationship with these people, but you can get a lot of private funding. People are excited about real estate, and they have funds to release on these programs. I have seen anywhere from 10 to 12%, or even higher, some 2 points. So rates are into that 10 plus. But the beauty of private fund is, if you're part of a group which is very active, it can be work as a cash basis. Like, so you can buy properties at a very high pace. There is no I want to say there's no red tape. The process is simple. So if you're looking for a quick close, that can be one source you can use. But again, this is relation based. So you need to know the person. You need to have some sort of a history with those. They should, because they're risking their money on a private transaction. So, but that's a really powerful source, and we'll touch base later. Some of the transactions with Nancy did. She used the combination of these these different sources. And the hard money, Nancy is not going to be happy when I say hard money, but it's a institutional money, which I want to say. That's a Chicago funding, and they have a lot of programs. And as we come out of COVID, with their restrictions are less. They're giving a lot of the appraisals are easier, the process is easier, and the rates are anywhere from 8 to 12%. Depends on what your credit score, what is your background, how much experience you have. So I'll let Nancy talk about that more later on that. This is just understanding, like, okay, exactly what is required on these kind of loan. What is the loan terms? It comes down to knowledge, guys. If you have the ability to work around and use your credit profile and use the different programs, depends on how many transactions you're doing and what type of transactions you're doing right now. It is based on that you can use mix and match. Like I am right now doing maybe 7 or 8 transactions at a time. I have already maximized on my residential, so I cannot use any of the first first program here, which is a 30-year fix. I cannot use because I already have a lot of maximize that. The only thing I'm using right now is through Chicago Funding, and they have plenty of programs to go with. Nancy, you just want to chime in a little bit here?
Yes, of course, Rahul. So, we tell people at some point, any given time, you may use one, you may use another, you may use a variety or combination. It really is specific on the circumstances of the property and the circumstances of your profile. Because we are going to check the credit, yes. I know a lot of people are rate shopping and they want the best interest rate, which is great. But unless you have the 6-figure income, or unless your gross income can handle your personal property, your credit cards, your car, or other debt, and you're able to handle all of the other investment debt, and it still meets within the guidelines, then yes, you're able to get the best interest rates with the residential investment loan. But at some point, if you have the opportunity to be able to have access to private lenders and private money, and you're able to buy those properties in cash, it's still a conservative risk, of course, but it has to meet certain guidelines. Is it a conservative risk for your lender? And is it an opportunity for you to be able to refinance as an exit strategy to pay back your lender and be able to get, and stabilize the property and be able to get a 30-year fixed rate product? I've had the opportunity to do one, and I've had the opportunity to do others. It was just dependent on the situation that the investor's in at the moment, the profile, the credit, the debt, and the property. Because I always tell people, you've got to see this from the numbers in the beginning, and you've got to see what the back end is going to look like. Is it still, does it fit the parameters for you to be able to refinance and pay back a lender or the private lender? Or is it an opportunity for them to say, yes, we'll finance it now, but then you're able to flip it and it's still a risk for, for good for you? Here's the refinance, the long term. This is the sheet that Rahul has up on the PowerPoint. Are you doing a residential Fannie Freddie loan where you qualify, where they're going to do your check stubs, your W-2s, your 2 years tax returns? Just know that you can only do up to 80% of the new value, right? You do have to have a 6-month seasoning on title. What does that mean? It just means that when you purchase the house, you finance it, you rehab it, and you rent it out, you're unable to cash out, or you're unable to touch the money or equity until you have 6 months on the title. So even if the rehab is done 30 days from now, even if you've leased it and rented it right away, we still have a seasoning that these lenders are going to require, and you have to qualify with your income and your W-2s and tax returns. Those are traditionally the best interest rates, but then we offer, what Chicago Funding is, to a lot of investors, your commercial. And this is what I tell people. We don't do the W-2s. We don't look at the income. I don't need the tax returns. Do we want to see them, that you filed them? Yes, of course. But it's qualifying the property and it's qualifying the risk, right? Even if it's your first property or your 10th property, as long as it makes sense. You can get decent interest rates. They're not the 10s, 11s, or 13% that people think they are. You can get those between the 4.5% and the 6% interest rate fixed for 30 years. So those are the things we navigate with you. Some of them will start residential on the purchase side, and some of them will finish residential or commercial on the refinance side. It just goes back to the scenario and the situation for you at that moment. What I do tell people all the time, and they ask me, what do you recommend? Whatever's best for you, you're the one that makes a decision. I can make suggestions, but you make the decision. I personally like, and this I speak for me, and I see other investors, because I've worked in lending so long, I don't want to jack up my debt with 5, 4, 3, 10 mortgages. I want my personal debt separate from my business debt. So when I understood the products and how Chicago Funding works, I was very excited because a lot of, I should say all of my investment properties, not a lot of or most, all of my investment properties were done through the commercial side. I don't want any of these mortgages under my personal credit report or under my husband's personal credit report. And I'm able to do a couple of things here. Number one, I'm able to leverage all of my investment properties into business debt and keep my personal credit report and my personal debt separate. That's number one. Number two, I'm able to maintain the great score because I'm not jacking up all of this debt under my personal credit profile. So I speak for me. A lot of people have a little bit of balance and they like to leverage it and they like to do both, but there isn't one answer. It's just the opportunity of all of these different products that are available for you, whether you're an investor now or you're looking to do some investing in the near future. A lot of people may not have the W-2s, may not have the check stubs because they're self-employed, because they're business owners, or because they write off a lot of their deductions and credits on their tax returns, and their net income is a lot lower than their gross income. So it's something that we navigate, and that's why, again, that would be another reason why you would want to go the commercial route, because you don't want to necessarily run into a situation where you can't qualify on this next building or on this next property, only because that debt to income ratio is going to hurt you and not help you. So on the commercial side for Chicago Funding products, again, it's qualifying the property, you're still guaranteeing the loan, but these mortgages are able to be financed under choice, your personal name or under your business name. So we'll help navigate that for you. There are some times that you're going to go one route or another route or do both, but that really depends on where you are as an investor.
Yeah, so like the overall, Nancy, like basically, as you said, it's your personal choice, but you need to understand what options are are open for you, and you can make the choices from there. When, like personally, I was saying, like when you're in a rental market or you're doing the rental profile, this is what I cannot done is like I've done some residential initially, and then I got into the commercial end of it, because it all comes down to your the time you spend or the money you spend to get the financing done to get into the next project. So for me, it was more for the speed. So I can do like some loans on the residential side, but some loans I had to do on the commercial side because I need to get the loans done. And commercially through Chicago Funding, it's as Nancy was saying, they are not looking at your tax returns. They're not looking at what's happening on your personal financing. They are more interested in the asset. They're more interested in the property. So if the property is doing good, if it is doing cash flow, or it is for your flip properties, if it's making sense, how much appraisal it might get at the back end, they are going to look at the property and not you. And based on that, they are going to give the interest rates. Obviously, your profile, as in your experience, matters, and how many transactions you have done definitely matters. So all those things are all related to the investment. So they're truly investment loans as compared to the Fannie Freddie product, which requires all the financial. But I guess just to touch base on the Chicago Funding or the commercial end of it, pre-COVID, Nancy, things were like very going really fast. Market was flooded with properties. A lot of things were happening. They actually were giving 90 days seasoning. So when I say seasoning, the day you purchase the property and the day you can get the refinance done on the back end, if it's a rental property, they were doing that within 90 days. Is that changed as we come to this end now?
The rumor is it's about to, but it
Mhm.
hasn't been official. So we're going to stick with where we're at right now. You're right, Rahul. Pre-COVID, there was a lot more flexibility. There was a lot more opportunity. There was a lot more programs, especially for the new investor. Everything kind of tightened up during COVID because the markets just got really nervous. They didn't know what was going to happen with the properties. They didn't know if people were going to pay their rent. They didn't know if investors were going to keep these mortgages. I mean, a lot of what ifs, right? And they didn't know how long this was going to, take before it resolves. So as 6 months and past the year, clearly, they have started loosening up a lot of the products again. I was very excited that they were able to open the products again for new investors because at one point they were only limiting the lending if you had more than 3 or 4 or 5 properties, and you were a seasoned investor, and they cut off any opportunities for new investors. But I was very excited a few months back that they opened those products again for new investors. So guys, if this is something that you feel that you want to get into and you want to learn how to do flips and you want to align yourself to start working and getting your funding in place, this is an opportunity for you for sure.
Yeah, I mean,
Yes,
right
products.
now, right now it's a phenomenal flip market. Means the people who are, means a lot of people who I know, they are sitting on the sidelines for a long time because nobody knew. Like this COVID was like so long. Like people thought it might be 3 months, that it was 6 months, and so it was going on, and things were just completely tight on the demand on the inventory side of it. The inventory was too low. The things were not. It was a completely seller's market. But what that helped is a lot of people actually were able to do phenomenal flips during the last year. I've seen people who have made over $100,000 on a multiple properties, and those were like a very small property. So you're not talking about anything like 500,000, not $1 million property. You're talking about 300,000, 200,000 properties where people are making like 70, 80, 100,000. Now I know Nancy did few transactions and she made a boatload of money. So, and those are the transactions were funded by all of these um, uh, resident or the commercial funding or Chicago funding, um, and and the rates were phenomenal for a lot of those. So there was a lot of opportunity and still there. I mean, it's like we don't know, especially in Chicago market right now. We generally have a cyclic market uh, in terms of the post-COVID. If you ask an agent like what is the best time to sell the property, is it comes to like you have to bring the property in the market early spring or like early summer. Once it comes to July, August, now the schools are starting and things are kind of closing on you, and you don't know whether you have to carry the property over the winter now. But now all those norms are out of the picture because the market is such a different market after post COVID. The things are just not working the way they were working 2 years back. A lot of the rental side also, the things are still moving and moving like crazy. If you get a property in the right location at the right price, you're getting the 30, 40 responses for people moving in, and that has COVID has given another dimension to that. A lot of people are moving uh, from the downtown area or from the more denser areas to the more suburban areas as their jobs profile is changing. A lot of people are working from home. Now they're working from home. They need more room, so they wanted to have a larger houses or more bedrooms. So things are just completely out of picture if you try to compare back to the normal market. So there's so much opportunity. At the same time, the financing side of it, they're looking at all this and they're making it simple to borrow money. I've seen people are doing just not even full appraisals, and then they're doing the appraisals on what they call, I forgot the term for it, but it's basically they're doing the online appraisal or whatever, and then they're giving the money. There's a lot of that is happening because they're trying to capture the commercial market is trying to capture the market share as people come out of the COVID.
Agreed, 100%, Raul. They're automated value modules. They're doing
Yeah. Okay.
just
Yeah. There you
the
go.
values online, And there's even a product or an opportunity that if you want to buy an auction property, you don't even have to go and have access to the property. They automatically can give you the financing just on the numbers if the property is the right property to finance it as is, unseen, without having any access. They'll still finance the purchase side and the rehab side.
Yeah, and that's the huge thing, because now the things are becoming easier for you to close, and things are becoming easier for you to get to the next level. So I guess you want to go through some examples, Nancy, to explain some of these programs. That will be I have this example. I don't know how you want to use this, or you want to use another.
Yeah,
Another
I know that
presentation
you
for
have
you.
a couple of properties on these slide shows. So what I tell people all the time, that these are real addresses, guys. You guys can look at this address. You guys can verify it online. We try to be very transparent, and this is just how, it's a cost of business, yes. Are you going to finance it? Probably at a higher rate, of course. But then you also have the opportunity to leverage the financing to make this deal work. You're going to finance the purchase money, you're going to finance the rehab money, and we'll be able to fund it, for you to be able to have an escrow and just kind of draw against that escrow to be able to complete the rehab. So this is a fix and flip loan that an investor took on in South Holland. The purchase price for this property was $100,000, and their budget for the rehab, probably a small cosmetic one, was $23,000. And this scenario, the funding was 90% of the purchase price was financed plus 100% of the rehab. So the total loan that was financed was $113,000, right? The investor only had to bring $10,000 to closing. So what ended up happening is that after all is said and done, once the purchase and rehab was done, final ARV after repair value came back at $175,000. So that was a good investment for the investor, and it was a good investment for the lender because it was a conservative risk, right? And for $10,000, they didn't have to bring or pay out of pocket the other $23,000 in the rehab. So once all said was done, once the rehab was taken care of, once it was leased out, and now they had to go and rent it.
Hold on, Nancy. So the fix and flip loan, which is a step one. So this is when the property is not not in a shape where you can rent it or you can sell it. So you're trying to add the value by doing the rehab. What was the interest on this side of it? Like, what was the interest rate on these kind of loans? It was that time, or maybe now. How much is the interest rate?
I'm going to say conservatively, it could have been anywhere between 8 and 10% on the first loan. And I say that range, guys, because it really depends on the credit score and your experience. So just as a rate, 8 to 10% interest only on the purchase renovation loan.
Okay. And then the duration, or the how long the loan. So let's say if it's this was a very small project, maybe because it's a $23,000 rehab, so not going to be more than 6 to 7 weeks of rehab time. But some of the projects which people might be doing, they might be like $100,000 rehabs. This fix and flip loans, they are right now, I think, allowing almost 18 months, right?
18 months. Pre-COVID, there were 12 months. And you can do an extension, maybe another 3 months. But now, post-COVID or during COVID, and they've opened up these products again, you can have these fix and flip loans for an 18th month term.
Okay. So this was a rental, and then they took the loan on the back end, and the rental loan program.
The back-end loans that they took out once everything was said and done, and they ordered a new appraisal after it was rehabbed, after it was rented, and we can show leases, because again, no W-2s and no check stubs if they went on the commercial end, and it looked like they did on this one. The ARV value came back at $175,000. They only needed to finance $131,000, right? Because they had to pay back that first loan, that first purchase renovation loan, got a 4.75 fixed 30-year fixed rate, and their payment, of course, was now $695, plus taxes and insurance, another $433. At the end of the day, this property was rented out $1,650 a month, guys. Their cash flow, the net cash flow after taxes, mortgage, insurance is being paid for, $1,650 minus maybe $1,100 or $1,130. Their cash flow is $522 a month. That property is now an income producing property and cash flows to this investor $522 a month.
Yeah, and the beauty of this whole transaction is if you can understand this transaction, this is a great transaction where you are just coming in, you are managing the financing of it, you're basically understand how you can finance. At the end of the day, if you look at it, you have no money invested, and that's the great part of this whole thing is your money invested is zero and your cash flow is 522. So at the end of the project, you can all your money back, which you can now deploy to the next one, and that's what we always call as a complete recycle formula, where you start with $100,000 of your own money, you finish a transaction, entire money comes back to you, and now you have entire money to put that to the next transaction. Because if you start leaving some money in the rental properties, $20,000, $30,000, $40,000, you're going to run to a point where you won't be able to do more because your stash is stuck in the property. And when you buy the property at the right price and use the right financing, as long as you get those appraised values, and right now appraisals are through the roof. I mean, it's like this was maybe last year, year and a half back maybe, Nancy, but now the appraisals in a lot of the areas are 30, 40, 50,000 more than what I generally expect these days because the market is so hot. So you can use that and you can actually borrow more money out to use for the next transaction. And that's what you can do with the financing right now.
Okay.
I have the other presentation which you put together that has more detail. You want to go through this example?
Of course, this is one of my, I say it, this is one of my babies. So this was a wholesale property that was acquired, a southwest side of Chicago, and I'm from the southwest side of Chicago or suburbs. So we purchased this property for $165. It is a 2-flat. And you know, we said, okay, this works. Didn't need a whole lot of rehab. If you go to the next screen, you'll see that that, you know, has another lot. It's a standard Chicago, you know, 2-flat. But what I loved about this property is the second floor is duplexed with the attic. So it was already finished. It had another master suite upstairs. And your traditional first floor, second floor had its 2 bedrooms, nice big spacious living room, kitchen, and a bath. All we did was put in a little bit of money into central air and redid a little bit of plumbing so we can add laundry units to each of the floors. And that was a huge hit with our tenants, clearly. Financed about $182, if I'm not mistaken, on the property. And I added a couple of comps because I had seen at the time that these comps in those areas were at least $250, $290. This comp here was $314. But of course it had more bedrooms. We did a private loan. I financed $182,500. My monthly payment was $1,825 every month while we were finishing the rehab, and it was only just a few months in. My new ARV value by the time I needed to refinance was $260,000 at the time. I refinanced 75% of that ARV value. And at the end of the day, when all said was done and we rented it out and leased it out, our mortgage payment is at the time it was $1,615. Now it's $1,653. But this is what the cash flow property, or this is what the income property that generates. First floor, we rented out for $11. Second floor is 1,200, and the garden unit, which is now finished, is rented out for 900. So we do get $3,200 a month. Our mortgage payment is $1,653, and it cash flows at least $1,500 a month. It's a beautiful property, and that was my first multi-unit. So I went out and looked for more multi-units.
Yeah, it's like those are the cash cows. Means we have when I started, we had opportunity to take a lot of properties in Berwyn area. So I own like 10 properties in Berwyn. They are very similar, 2-3 flat, like this example. And Chicago market, like especially those buildings are so solid building. I love those, like those big buildings with they have a lot of nice value to it, and they're really solid. There's nothing you need to do once they are done, and that's what we always try to do when we are investing. When you're putting a product together, especially if it's a rental property, it's a flip. It's a different story. Now you can look at what competition you have and how much money you want to put there to get that maximum ARV or maximum appraisal, so you can maximize your project. When it comes to the rental, it's a little bit different, and that's what you need to understand. And that how much money you need to put into rentals is a skill set which you will get it as you do too many transactions. But all these properties, they don't need like a flip kind of a rehab, but what you need to do is you need to basically fix the long-term things, and that goes into your capital. So especially the properties like this, which has a flat roof or maybe a tuck pointing on outside, those are the pricey things. If you have those issues, you should do those when you're doing the property at the front end. Put that money into your loan, so it doesn't have any problems throughout the life of 5, 10, 15 years of renting. And that's the model which I like to run, which is a headache-free model, and I don't get many phone calls if I do that kind of stuff. But this is beautiful product. Like I can say, she still have a lot of equity, more than 20% in the. And I'm sure now, if you look at the building at this stage, the price might be what, 400 or 360 or something, like more than that now.
It's to 340. Yes, that's correct.
Yeah, it's 340, 350. But it's like a stock. Like I look at my portfolio right now. If I can sell everything, I can make millions. But then who knows? Like I don't want to sell these properties because they're like golden egg. Like you just want those eggs coming all the time. You don't want to kill that goose which is giving that golden egg. Even if it makes you $100,000, I would rather take 1,500 coming every month as compared to 100,000 just one time.
And the beauty of these properties, and I say, and guys, people can start small, that's fine. People can start multi-units. Just understand that they are a little riskier, yes. You're going to require with more reserves, yes, when you're looking for financing. And those are the things that we need to discuss and talk about. It's not the same as financing a one single family home. When you're doing multi-unit, it's a different product and it's a different risk, but of course the return is also better. Because my thought process to this was, even if I have one vacancy, right, a couple of times a year because the leases or the apartments or the turnover, but that's okay, because one unit or 2 units occupied any given time covers the mortgage payment, and it still cash flows for us. So it quickly built up my reserves within the first 6 months. I was very excited for that. And now we see it 3.5 years later. And now I tell investors, start, but don't start, whether you start small or you start taking risks, but the seasoning and the rental and the experience is only going to open other opportunities for more lending and for more credit and for more risk. At any given time, many investors are working 3, 4 multiple properties at the same time because of the lines of credit that have opened up for them, because of more access to money, and because of the experience that they're gaining as investors.
So Nancy, I guess you know your financing, and that's why you're Chicago Funding. somebody who is starting new or starting, I don't know who is in the crowd here right now, but the people who wants to start, I guess there's a great opportunity on this weekend, right? Means we are doing the another 3 day, and I'm so excited about that because it's going to be in person after like 2 years, 1.5 years maybe. Is that something you recommend to all?
Absolutely. I mean, Rahul, I think for the last 5 years, or for the last 5, 6 years, I had already gone to a couple of other 3-day events. And the one thing that caught my attention when a friend recommended me to come to this one with Andrew Holmes was, you know, that this community was local. That yes, all of these others had a lot of show and a lot of information and a lot of resources, but all of these other companies were not local. And it's true because even when I had scenarios, I had a fax or call or scan or email, and I was talking to consultants that were in California, Iowa, or Ohio. They had no idea what my neighborhoods looked like. They had no idea on comparing apples with oranges, right? So it was really difficult for me to even get, an understanding. And when I started coming to events and I came to the 3-day event, like the one that's happening this weekend, that's where I was just 100% convinced and said, yes, this is where I need to be because the community and the network was local. I knew that I was able to have a community and a network behind me if I was in trouble, if I had questions, if I would pick up the phone and say, hey guys, can someone run and see a property with me? Can someone double check and analyze the numbers with me? Can someone just have a second or third pair of eyes in regards to, assessing or analyzing a property? So I was very excited with that because I was able to meet other investors that were investing either in the same city or area or communities that I was looking to buy into. And that was a game changer for me, Rahul. I don't say it just because, it's a commercial. No, I say it because it truly changed my life. Having compared all of these different events that were out there, this is the one that did it for us, for sure.
No, I guess my experience with like we are doing this, I stopped counting now. I think it's the 21st event for us, and the main thing I see in people is when they come and they network, you find somebody who is similar to your profile, and I keep going back to that profile. That's the key step for me. So whenever I'm teaching people who come to this thing, the first thing we try to basically um, identifies, okay, who are you, exactly where are you, and what goal you can put for yourself for next 2 years. And once you achieve that 2 year goal, obviously you are going to keep changing it. So for somebody like you, Nancy, who came to 3 day, you must have seen like a lot of different people doing a lot of different things, and these are all people who are doing in last 2 3 years. It's not like uh, it's like I started doing 10 years. There are a lot of people who started doing 5 6 years back, but there are a bunch of people who are doing it in today's market. So every 3 day has a different flavor. As the market changes, we kind of bring the right information for the people to in front of them. Okay, in current market condition, what is possible? And that's the biggest thing for me in a 3 day is to understanding what's coming your way and how you can use that to your advantage and go to the next level. Because every 3 day, like the last 2 3 3 days, we're like heart of COVID. A lot of things were closed, things were different. Now we are coming out of it. Things are going to open a lot. There's a huge opportunity for a lot of people locally, especially in markets like Chicago market, because we are so tight state. There's so many laws and regulations and rules that it takes a while for something to come through the system and start getting into investors' hand. So it's very important for you to know exactly when to do what. And if people on the call, if they are not signed up, I'll encourage them. It's a online. You can do a Zoom or you can come in person. It's in Elmhurst, I believe. Yeah, it's in Elmhurst. This Friday, Saturday, or Sunday. Or if you're not sure, then it's a Zoom call. You can do it online, sitting in your own house. So it's one of the experiences which I've seen a lot of people who come to the event. They have no clue, or at least they are confused about what's the next step, and then they find, okay, uh, the examples which we bring there. Yeah, this person is my profile. he's able to do it in last year. He used all the resources which I have, and then I can just replicate that and get to the level which I want to go. So highly encouraged for people who haven't signed up. They can come and they can enjoy the 3 day. I'm not sure Hugo. Oh, Hugo left. Um, Nancy, if you want to cover anything else, I'm not. I was not. I haven't seen any questions or anything, but
I'm still here, Rahul.
okay. You got. This is just. I can. I know you got. You have explained this 3 day, but is there anything else we need to cover today, or?
Um, are there any questions on the line, everyone? Any questions for Rahul or Nancy?
How do I talk to Nancy?
Okay.
Can we put the information, Nancy, in the chat box for people to reach for Chicago funding?
I don't know if there's a screen with their contact information, but if there isn't a screen, guys, this is real simple. Nancy at ChicagoFunding.org. I'm still catching up on emails because I've been sick for a couple of days. But just go ahead and send us an email, Nancy at ChicagoFunding.org, and a number to reach me. I think we could do the chat box. Here, I'll just put the information in the chat box, and I think everyone can receive it. Right, Hugo?
Correct.
All right. So everyone. There we go. Okay. I'll do that.
And friends, we're going to do something very special. First of all, thank you very much, Rahul and Nancy, for joining us today and giving us great information about getting funded in this pandemic. So in my particular case, the 3-day was a turning point for us. We attended about 2.5 years ago, and ever since, it's been incredible, not only for the people that we met at that event. That, to me, that was the most valuable thing that I was able to get, meeting the right funding partners, meeting the right people, investors, like-minded, like Rahul and many other key players in the industry. So attending the 3-day event was the light at the end of the tunnel for us, and obviously becoming part of Mastery afterwards. So we're going to do something really cool. For those of you who still don't have a ticket, we are going to give you a free ticket to attend to the 3-day virtually. Okay, so please send us an email to support@ChicagoDealVault.com. If you still have not registered, we're going to give you a free ticket for the 3-day event, so that they help you replicate many people's successes. Okay, we've built a rental empire of over 30 properties. So it's been amazing, especially for the network, the people, the friendship we've created by joining this incredible group. So thank you very much, Rahul, Nancy, for joining today. And I look forward to seeing you all at the 3-day this Friday, July 16, Saturday 17, and Sunday 18.
Yeah, thanks, Hugo. I guess thanks for having us, and thanks for the tickets. You are sponsoring those, and we appreciate that. And you're always a part of it, and you helped a lot of people who joined and who came to 3 days. So it's the product you have is a real asset. Somebody who really want to start, and the support you get from your product is a lot. And we teach that as a part of our course. When we go through that, we actually have the DealVault, and who goes through that, and because it's a product which I use, it's a product which Nancy use. We are using it to get, and especially it's going to become more valuable in the future, in the current future, is reaching to the off-market properties. There's so many properties, people are behind, they're in pre-foreclosure, and that number is going to grow like crazy in next 6 months, especially in the Chicago market. So having a product, a tool which DealVault offers, you can reach to those guys, and that is going to be the #1 strategy for a lot of investors to buy the properties in next 6 months before they reach the auction. And It's just incredible to find great values in those properties. As the people in those properties in pre-foreclosure, they don't understand what's happening. And if you can have a knowledge to talk to them and out of get them out of that situation, you're helping them. At the same time, you're getting a great property at a great price. So it's a win-win for both. But it just comes down to knowledge and how to use that product which Hugo has. So again, thank you for having us. And anybody who comes to 3-day, just say hi. I'll be there. I'll be available to talk at the 3-day too.
Thank you very much, Rahul. Thank you very much, Nancy. And I look forward to seeing you all at the 3-day. So please email us if you still have not registered. We're going to give you a free ticket for the event. So thank you, everyone, and have a wonderful evening. Again, the email is support@ChicagoDealVault.com. Thank you, and have a great evening. I'm going to stay on the line for the next couple of minutes in case anybody has any questions.
Okay. Thank you.
Thank you. Bye.